Hello and welcome back to All Things Money. I'm your host, David Blain. And during today's show, we're talking about bear markets, the necessary evil. We're continuing with a topic that I actually started in last year in 2012, but that is just so important as we've gone from the bear market in 2009. We've had a nice recovery here, coming up on 4 years without a sustained decline in the market. Sure, the past couple of years things have leveled out, and there have been times in there that have been declines in the market, but as far as a bear market, we've not really experienced one. And so I'm kind of priming you that, you know, it's not always this way. Maybe you're new to investing, or maybe you think that the Dodd-Frank bill or the Consumer Protection Finance Agency that the government has instituted is somehow going to insulate your portfolio going forward, and that, you know, there'll be no more Lehman Brothers, there'll be no more GM bailouts. You know, that's just not the case. And so we want to talk a lot here today about risk and reward, and just kind of re-anchoring people as to returns and how returns are generated in the investment world. Not just stocks. I use stocks as the example, but this could apply to any sort of business venture, any sort of real estate venture that you have capital at risk. So going back to the expected return and risk are related. If you invest in a 30-day T-bill, your expected return is pretty much guaranteed unless the federal government goes out of business in the next 30 days. You're assured a return, a stated rate of return. There's virtually no risk involved. As you move away from treasuries and say you loan your money to a different type of company, or the maturity level, you know, a 30-year treasury bond, you know, what's the U.S. going to look like in 30 years? Is the U.S. still going to pay its bills? There's more risk. And so to be compensated for that risk, you should receive more return. So the stated rate of a 30-year treasury bond is much more than the 30-day T-bill. The same thing applies with stocks. As I used the example in the last segment, if you're saving for college 7 to 10 years from now and you invested in a stock that pays a dividend, well, there's no assurance, number one, that the dividend will continue. There's no assurance that that company will be in business. And three, there's no assurance as to what the price will be if you bought a 7-year bond. As long as that company is still in business, or the federal government, you will receive your principal. So risk and return are related. If stocks always returned more than the bond market, there would be no risk. If you came and you said, well, the bonds are paying 4% and the stock market always returns 8, 9%, there would be no risk involved, and by definition, it could not return more than the bond market. And so the volatility of those returns is a necessary part of investing. At the individual company level, there has to be the risk that the dividend gets cut, or the dividends don't grow as fast as somebody else, or that the company goes out of business. There has to be some element of risk. Within the stock market, we also tend to apply an additional risk premium to a small company. I mean, let's face it, the small company down the street, and I know you all have seen it the past several years, it's a lot more likely to go out of business than Google or Apple. You know, with billions of dollars of revenue from all over the world, they're much more stable. It's not to say that it can't happen. You know, Enron, MCI WorldCom, you know, collapsed overnight. But in general, small companies require an additional return for you to take the risk in it. You know, it's a startup company, or something with not a lot of revenue, or just one product line. So small companies traditionally provide an even greater return than larger companies. As we look beyond that, we also see that value companies, and by value companies, I mean companies that are trading that at very low multiples of their earnings, that nobody likes them, people think they're going to go out of business. They typically produce actually more return than the growth companies. A great example is, if you rewind the clock kind of back to last summer, and Apple became the #1 company in the world, the largest company in the world in terms of market capitalization. And I was telling people at the time, there's only one direction for Apple to go from this point, and it's down. because the company just cannot keep growing and growing and consuming the whole world, and the whole world has a finite GDP. Anyway, so it has gone down significantly since then, and so it's a growth company, and people were overpaying for that growth. They felt like, well, Apple's going to continue growing, it's going to grow forever. Whereas if you go back to, say, 2009, and the auto companies were, Chrysler and GM were getting bailouts, and the U.S. auto manufacturers were just holding on, and Ford, was trading at $2 or $3 a share, and dividends being cut, and that's a value company. Is that there's some sort of, people are not overpaying for growth. There's not a lot of growth there. The opposite of a growth company is a value company, and so there's more risk involved, and so you would expect more return, and that is exactly what happened. So in this whole expected risk and return, at least in the stock market, the main factors are, number one, just investing in the stock market. You have a higher expected return, and in return you have more risk. As you move into smaller companies, the expected return also goes up, and into value companies, the expected return goes up, but the risk also goes up. And remember, that's expected return. It's not a guaranteed return. It's not an assured return. But that's what provides the risk premium over the bond market, and it's what allows investors to have the potential to make more than the bond market. Okay, well, that brings us to our second break. When we come back next segment, we'll go ahead and wrap up with this topic. So for All Things Money, I'm David Blain.